Joining us are Nancy Davis from Quadratic Capital Management and David Zervos from Jefferies. David, boy, what happened there into the close, you think? And I guess building on that, what do you sell when the Fed thinks the economy is slowing enough that it doesn't have to keep hiking because credit's going to get harder to come by?
You know, I think this 2 weeks has introduced a lot of uncertainty to the Fed, to the markets, to everybody involved as to how much of a pullback there will be in the credit provision process, particularly to small and medium-sized businesses, which are a bit of the lifeblood of the economy, or are the lifeblood of the economy. So we're flying a little more blind. That should take risk premiums up, and I think, you know, you're seeing a bit of that in equities. I'm not sure, you know, how to explain the +1 to -2 or what down 1.5. You know, there's a lot of positioning that no doubt is in there, and I don't know that we want to get into every little minutia, but I do think this brings in a lot more uncertainty than where we were before, and that's why the front end of the bond market is priced the way it is. People go to that for safety. They see higher probabilities of accidents, and that's the sort of the hedge for accidents, if you will. And that's really been the fundamental change. A lot of stuff hasn't really changed this year in terms of levels. S&Ps are largely unchanged, high yields unchanged. The real change is the 2-year note level yield is significantly lower, and the prospect for lower rates down the road
I don't think you told me what you sell in this environment under these conditions, though. That was the end of my question.
I think you stick with what we've been saying, which is you stay away from the riskiest part of the capital structure in the United States economy, which is equities, and you focus on the senior secured part of the capital structure that has really, really high yields in it. And that, to me, is, you know, high yield debt. And today I'm actually quite impressed that the HYG ETF is ending, at least 5 seconds ago when I looked, up on the day with the S&P down 60 points. So for me, I think the fixed income markets are still the place to hide. The credit markets are still the place to hide. And the equity just doesn't give you the risk return profile that you need, given where we are in the cycle with this Fed.
Nancy, I want to get your thoughts on what we heard from Fed Chair Powell, especially given the fact that we've seen a change in some key language, the fact that it's no longer ongoing, that we are seeing words like may and some when it comes to additional policy firming. Was this a dovish 25 basis point hike today?
Absolutely, Morgan. The bumpy replaces pain. Pain was the word Powell kept using at Jackson Hole, and today he talked about bumpy. He talked about how the credit markets are tightening and how that will be tightening policy. He also kind of dodged the question on quantitative tightening. They kept QT the same, but since they've put in place all these facilities, the Fed's balance sheet is expanding right now. They might not want to call it quantitative tightening, but it's pumping liquidity into the system. And I think that's really dovish. So I actually think I would probably go the opposite way. If I was going to be calling the market, I would actually say credit is really priced, you know, rates are the yield curve is incredibly inverted. It's priced still for a massive recession. It's lower now than it was even in the late 80s. And so I think the bond markets are really saying the Fed is still making a policy mistake. It's normalized a little bit with the front end since the Silicon Valley Bank blow up. But there's a lot more, I think, room in there for credit spreads to widen and more defaults to come in, because right now we haven't seen any pickup in the default cycle.